Welcome to the Propertybuyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Welcome to another edition of the Propertybuyer Podcast. In this episode, we'll do a deep dive into the world of commercial property and examine how you can buy or invest in commercial property. Many investors have been afraid to embrace the opportunities of commercial property after hearing bad stories coming out of the GFC, or most recently during COVID, when commercial valuations took a significant hit. In this episode, we'll cover the key differences between residential and commercial property investment, financial metrics to focus on, how to choose the right location and understanding market trends, the types of commercial properties and their investment potential. We'll look at due diligence and risk management, current trends, and some case studies of successful investors. You'll also hear valuable advice for aspiring investors and discuss how technology is reshaping the commercial property landscape. So whether you're a seasoned investor or you're just starting out, this episode is packed with insights to help you make informed decisions in the commercial real estate market. Our special guest today is Alberto de Grava. He's a seasoned expert in the field, and we'll be exploring the ins and outs of commercial property from getting started to advanced strategies. Alberto is currently our commercial principal buyer's agent at Propertybuyer. Welcome, Alberto. It's great to have you in the studio.
Thank you for having me, Rich. It's a pleasure to be here.
Wonderful. Now, Alberto, we have a little tradition in the Propertybuyer Podcast where we start with a thought of the week. And I've got a quote I'm going to throw at you. I'd love to get your thoughts on this one. And it's by Henry David Thoreau, who said, "Go confidently in the direction of your dreams. Live the life you have imagined." What do you take away from that quote?
I can definitely relate to that quote. It applies to my case, my life. As you know, Rich, I wasn't born in Australia, but in Italy. And all of my life, I was dreaming of living overseas and hopefully in a country that was English speaking and potentially doing some big deals. So, I moved to Australia 13 years ago because I had a dream and I pursued it and I imagined it and now I'm living it.
Fantastic. And look, we love your Italian accent. We call you our Italian stallion internally, mate. So we love that. But no, we really hats off to you, because I think it's a big step to move to another country. But, I've always admired that you have goals and you set out to achieve them. But, I think if you don't imagine something in your life, then you won't really realize it. I think it's really important for everybody who's a listener to have a vivid imagination and to really step out in the direction of your dreams. Otherwise, what's the point, right?
That's it. I mean, it applies to any area of your life, and also to business or investment. So, which is what we're talking about today.
Fantastic. So just, if I may, Alberto, just get a little bit more background on you. Tell us a bit more how you got into the commercial real estate sector and what inspired you to become a buyer's agent in this space.
Yeah, sure. So I got into real estate 10 years ago, inspired by people around me. And obviously, it's always been an interest of mine to being able to invest in property, and whether it be residential or commercial. So I was lucky enough to be introduced to a commercial sales and leasing agency down in Sydney. And lucky enough, I started to work for them initially as a leasing agent and then doing some sales as well. So 5-6 years later, after having built my reputation, I decided to take a break from agency because it was all about transactions, and I very much resonated with the relationship piece when talking to clients. And I got into the buyer's agency side because when I took a break, funny enough, in the same week, 3 of my former clients called me up saying, hey, what are you doing now? Are you working by yourself? I need your help. You know me. I trust you. I need to buy a property. Can you find it for me? I'll pay you a fee. You can be my buyer agent.
There you go.
And I thought, what? How does that work? So it literally came to me. Sometimes the universe is talking to you, and you have to listen, which is what I did. I did my research and found out that there was a lot of buyer's agents in residential, but very, very few in commercial, if not any. And that's when, I started to look around and found you, Rich.
Fantastic. Well, what a story. And it's great you've put the, taken a different perspective and a different approach to finding, to working in this industry. Because I think you touched on a point there about you really enjoy the relationship side of things. And that applies to a lot of our residential buyers agents too that have joined me. And over the years, they've gone, we don't just want to do another transaction. We actually really enjoy the consulting. We really enjoy guiding the client to make a good decision. Yeah. And obviously you've really embraced that in your role.
Yeah, that's right. And, it obviously touches on a variety of aspects about property. It's not just about buying or selling a property. And there's an ecosystem around it that you can always add value to someone.
Fantastic. So let me ask you just a bit about, or just unpacking the whole commercial property investment sector. What are the key differences between investing in a residential property versus investing in a commercial property? Now, why would someone consider investing in a commercial property?
Sure. I would say the key differences between commercial and resi are given by the nature of commercial being way more sophisticated compared to resi. We have more metrics and things to think about. For example, we have to look at the zonings because not every zoning will allow a specific business to be operated. Whereas, in residential, it's residential. You can live in a house or an apartment. So commercial, we look at zoning. We have to understand the specific uses that are allowed or not allowed. And then we have different asset types. We've got industrial, we've got commercial office space, we have retail, we have medical, we have a more specialized asset types as well. And then we look at rates per square meter. When it comes to leasing or selling, we look at yields. We have to understand if it's an investment, we have to understand a bit about the tenant and their business and their ability to pay rent. So there is a variety of points that we have to consider when talking commercial that in resi are not really a problem at all.
So it's a lot more complicated and it's easier to make mistakes. But I guess sort of the question around resi versus commercial, I get asked several times a week, Rich, should I buy commercial first or should I buy resi first? But I think investors need to understand the risks in both of those things. And I think, typically you would say the yields are higher. Would you believe the yields are higher in commercial than in resi? How would you say?
Yields are definitely higher. Firstly, we talk about net yields instead of gross yields in residential. And by net yields, we mean the rent after the outgoings have been paid for. And in most of the cases, the commercial tenant will pay for the outgoings. So the investor is left with a net rent, which in most of the cases will probably return twice what a residential property would deliver in terms of yield. And, one of the myths is also commercial property is very risky and it doesn't grow in value or it's empty for a long time. Well, that's not true. I mean, it's true in some cases. They grow as much as residential unless someone buys the wrong property in the wrong area or the wrong asset type. So in that case, yes, it's very risky. But if you buy the right asset type in the right location, you'll get a better yield. you'll get the same growth, if not higher in some cases, if you know what you're doing, and your vacancy is very low as well. So to me, it is a superior way of investing, but obviously you need to know what to do.
Got it. So tell me, if you're I guess a newbie to the commercial investment space, what sort of steps would you advise a new investor take when thinking about a commercial investment property, and how important is the research, and are there any sort of resources out there you'd recommend for someone?
I guess the first step, it's all about finance. So a key and big difference with residential comes with the deposit required to purchase a commercial property, whether it be for your business or an investment. Usually we talk about a 30% deposit, whereas in resi, you would probably consider a 10% deposit. And if you're more conservative, 20. So you don't pay the insurance, right? But in commercial, you need, best case scenario, 20% deposit, if not 30, and in some cases it could be even higher. So that would be the first step. Have I got enough deposit or equity that I can extract and use to purchase commercial? The second step would be understanding the structure or entity to purchase commercial property, because and that in that case, we don't give any advice, but I strongly recommend anyone to have a chat to their accountant. Should they buy in their personal name? Should they buy in a trust, in a company or any other entity? That will come down to each and every individual circumstances. So once you've got your deposit, you had a chat to your accountant, you know the structure, you have a chat to your broker to understand the budget, start to form that, the team of specialists around you that will assist you in the process. You also need a very good solicitor that can read through the contract and the lease, because there could be very sneaky clauses, and we'll probably touch on this later on, that could jeopardize your investment. So once you've done these first steps, then obviously it is about understanding the market. And unfortunately, commercial real estate doesn't really have much information out there as much as resi. I mean, residential, you can jump on domain and real estate. You've got absolutely all data about rentals and sales. They're public. Whereas in commercial, they're not. Most of the cases you have to call up the agent to understand how much it sold for or it got leased for. There could be incentives that have not been disclosed, and therefore they could change your metrics. There's a lot of moving parts.
A lot behind the scenes is the message that you're communicating here. There's a lot
behind the scenes.
It's not for the faint-hearted. I think the message here for our listeners is, Alberto, is that if you are thinking of investing in commercial property, it's not just to click and collect. It's not like just picking up a box of goodies from Bunnings. It's very much taking a step backward and going, hey, do I have the financial capacity to get the deposit? Is it the right strategy for me? Have I got enough funds if I don't have a tenant for 3 months to carry me across the line and pay the mortgage that I've got on this property? So it's very important to, as you say, to do the research, and some of that data is not available. So tell me.
And obviously understanding the value of a commercial property, it's
that's what I was going to ask you. Tell me,
there you go.
Quick lesson. How do we value a commercial property? Give us the quick lesson in valuing commercial properties.
There's a few ways to do it. The two most common ways to value a commercial are, for example, if you are a owner occupier, so you're purchasing the property for your business and therefore you don't really care about the rental return. You just have to look at the price per square meter. So again, understanding in the area what other properties that are similar to the one that you're buying have sold understand their price per square meter, and there will always be differences. It's never going to be a uniform value that you find. So in each and every case, again, you have to call up the agent and understand, hey, what happened here? Why this sale is different, is totally different to everything else that I've got, and then you'll understand why.
Yeah, exactly.
So that is one way is with price per square meter. And the second method, which is more connected to investment stock, is understanding the cap rate. So the capitalization rate or yield, which means you have a property that is generating X income, X net income. So let's do an example. There is a property that has got $60,000 in net income, right? Plus GST, plus outgoings that are paid by the tenant. What is the cap rate in the area? So similar properties in the area, what are they trading at? Are they trading at 5%, 5.5%, 6%, 6.5%? And why? So once we understand what the cap rate in the area is, then you apply the cap rate to the net rent. So let's say, to make things easy, the cap rate in the area is 6% for similar properties. Then you divide 60,000 by 6%, and the value of your property is 1 million.
Yep.
That is the cap rate valuation style.
Yep. And so I guess the risk on that too is that if there's an inflated lease on that property, then obviously you're going to be buying potentially at an inflated price, right? So
absolutely,
you have to peel back the onion layers and really uncover what it is you're buying, and making sure that you're not just buying on a sort of a false cap rate, but you're buying on a legitimate cap rate.
Correct. That is of paramount importance, because let's say even if, it stacks up in terms of valuation, but you want to buy good value for money. And we see that all the time, where whether it's a genuine tenant or a leaseback from the owner, they pump up the rent by 10, 20%, in some cases even more, and they want to sell at the same cap rate. So therefore, what that means is they're getting 10, 20% extra on their sale price, which could be, on $1 million, could be 100, 200,000 more. But what that means for the investor is they're paying overs. They're paying overs because if that tenant moves out and the market rates are 10, 20% lower, that's what you're going to end up with. An underperforming asset or a dud that you've paid too much for.
So Alberto, tell us about, I guess some of the risks or the financial aspects, and just making sure it's a legitimate purchase. What do you look for apart from the cap rate and maybe the per square meter rate as a comparison? But tell us about maybe the leases and any other consideration you might think about to sort of de-risk a property purchase.
Yeah, so obviously the lease that is attached to a commercial property is almost 50% of the reason why an investor would buy that, as opposed to the one next door that it's vacant. So it's very important to have a clear understanding of the lease attached to it. And that's as important to you as important it is for the lender, because some lenders would have very strict criteria where they need, for example, a minimum of 2 or 3 years left on the lease to lend you money. So that's very important as well to understand before you start the search. Whereas maybe you have a more solid financial position, you can go for a more risky asset that it's got 6 months or 12 months left on the lease. And obviously, the length of the lease plays a big part in the valuation of the property and the risk that the investor is willing to take. So let's say this same property has got 5 years left on the lease to a very solid tenant. And, the cap rate in the area is 6%. Well, I can guarantee you there will be a lot of investors that are willing to pay below 6% because they see a lot of value and security. It is a strong tenant. The lease has got 5 years. They've got, for example, an annual increase of 3 or 4% in it. It's got strong security, as in bank guarantee or a bond in place. So those are all considerations that have to be taken into account. Whereas maybe the same property that it's got, 6 months or 12 months left, or is becoming vacant tomorrow, there will be less investors willing to take the risk of vacancy and therefore of releasing the property. And in that case, it could trade at 6.25 or 6.5 because of that risk.
Okay, so that's what I was going to ask you. What's the differential in valuation? Could it be 10 or 20% difference in value if you've only got 1 year left?
Yeah,
versus
definitely.
Something at 5 year left. Yeah, that's significant.
Absolutely.
That's huge.
Yeah.
Okay.
And again, it depends on understanding also the vacancy in the area and what would be the market rent achievable.
Okay. Talk to me
because
about... Yeah, go on.
So just on the cap rate, that we said before, there could be instances, for example, where the property is under rented.
Yes.
Is under rented, and maybe in residential it's a bad thing, but in commercial it's a great thing.
It's a good thing
because
there's opportunity for upside, right? Yeah.
It's a great thing. Yeah, exactly. It's opportunity for upside, because upside means increasing value.
Absolutely. I mean, it could be like a little mini set of strata units in a suburban shopping centre, and 3 out of the 4 are leased and the 4th one's not. You're selling it on a cap rate. Bingo, you get a tenant in for the 4th one. Instantly, your valuation's gone up, So,
exactly.
Yeah.
Exactly right.
Talk to me about location and the sort of local market factors. Like, how important is location? Is it just all about the metric and looking at the cap rate, or does location really have a significant part in that investment decision when you're choosing a commercial property for a client?
Location is very important. I mean, I've got every day I receive clients, questioning me about, I want a high yielding property. Okay, what's high yield for you? And then, sure, I can find a 7, 8, 10, 20% yielding property, but that's going to be in whoop, right?
Yeah.
Where if the property will become vacant one day, it's probably going to sit like that forever. And you've lost all the value. Whereas, so we think it's better to invest in capital markets, capital cities where your vacancy is very low. The area is not big for industrial or commercial or retail. So understanding where those locations are, it's the first step of finding a good property, because you could buy the best property in the worst location, and then sooner rather than later, you'll be hit with that. But you can buy the worst property in the best location, and it's going to perform really well over time. So location is very, very important.
Okay. So
also understanding.
So I was just going to say, to give me a concrete example. So you're telling me that a commercial service station in the middle of Mount Isa, giving you 17.5% may not be the best outcome of a $3 million purchase compared to a $3 million industrial unit on the outskirts of Sydney.
Yeah, or for example, the same, let's say, industrial, you buy in regional New South Wales or regional Southeast Queensland, which are only 3 hours away from the city, and they deliver 7.5, maybe 8% net yield, but at what risk? Risk of vacancy, and then what's going to be like the growth as well? When you can buy the same asset in that nearby city, delivering a 6% or thereabouts, plus all your capital growth. I mean, a 1% or 1.5% on the long term, it's nothing.
That's it. That's really good. There's some good thoughts there, Alberto. We really appreciate you tuning in to the Property Buyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word of mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues and ask them to subscribe to the Property Buyer Podcast. It would be a big help and we'd be very grateful for your support. Thanks once again for sharing the links. And now let's get back to the podcast. Tell us about, we touched in the beginning around the types of commercial properties. Tell us about, I guess, the risk differential or the return differential on the different types of commercial that you're talking about. I mean, you've mentioned retail, you've mentioned office, you mentioned medical. Like, just talk me through, just for our investor clients out there, investor audience, what are the pros and cons of each type of property?
Obviously, we'll talk about mainly the Eastern Seaboard, which is the locations that we buy in, that we are in every single day. So from Canberra all the way up to Sydney and Southeast Queensland. The best asset for the last 5 to 10 years has been industrial, for obvious reasons, related to online shopping. That's been growing both in value and in rentals. And the truth is, all the data coming from the big companies that do research every single month, there is still not enough industrial space for all the business and all the businesses out there. Obviously, there will be pockets where there's a little bit of oversupply, but in most cases, I mean, all over Australia, I think recently the vacancy rate for industrial was between 2 and 3%. And in some markets like Brisbane and Sydney is below 1%. So that means there is absolutely nothing available.
Very tight.
And very tight markets. And when that happens, obviously rents go up. And guess what? When rents go up, value goes up.
Exactly. It's a good circle.
So industrial has been performing really well. Office and retail is a different story. Retail, it's a mixed bag. It really depends on what. And we don't really look at big shopping centers like Westfield, right? We have to look at smaller shopping centers, neighborhood shopping centers, and retail shops. That's a mixed bag. The returns are slightly higher than industrial. Sorry, did you want to know about the yields as well, Rich?
Yeah, just mention that along the way. Yeah, mention it along the way, please.
Yeah, probably industrial, along the Eastern Seaboard, it could be anywhere from 5% to 6.5% for a good investment stock, and in some cases it could be higher. Retail is sort of similar. Maybe can easily go up to 7%, if not more. But again, you have to look at the risk associated with that. We don't want to buy in, in high streets like Oxford Street or Crown Street in Sydney that have been empty forever. But if we go in more suburban areas or small neighborhood shopping centers, those are all busy. They're busy because they're servicing the local area. And, with remote working as well, people are more at home. They spend more time in the local cafes and all the services connected to those. So retail could be a good investment right now.
Okay.
Office delivers a higher yield right now because of the risk that it implies. Again, Sydney CBD, Brisbane CBD yields are probably around 7 to 8%. But there is a 15 to 20% vacancy. And in some cases, you give a 30 to 40% incentive to the tenant. So your fantastic yield is going to be eaten up very quickly by all the money that you have to outlay to attract a good tenant or retain them.
That's it. And just lastly, what about medical? You want to touch on that?
Yeah, medical, it's been going really well. Obviously, during COVID and on the back of that, most investors have seen medical as the safe investment, and therefore yields have gone up, have gone down. Medical is tend to stay in the same premises for a very long time anyway. Also because they invest a substantial amount of money on their fit out, whether it's, a GP studio or a dental or a specialist. So it is a very good investment. Again, yields could be around, because they're mostly in retail or office spaces, it could be between 5.5% to 6.5% right now.
Okay, excellent.
But during COVID, they were down to 4.5%.
Yeah. I think
we've seen worse than 4%.
Yeah.
There's some properties that trade below 4% right now with the current interest rates.
Yeah.
Those are crazy.
Well, I think I saw some. I think even we were talking about Bunnings a minute ago. I think we saw a Bunnings go for like 3.5% somewhere. I remember seeing.
Yeah, there you go.
This is crazy. Just
Yeah, you usually see some of those big auction houses selling beautifully looking fast food or small shopping centers or petrol stations for very, very sharp yields.
Not necessarily the best investment. Alberto, tell us about your due diligence process. I think this is something I know that personally you do exceptionally well, but just take us through just a quick snapshot of how you would guide a client through the buying process in terms of due diligence. What are the steps that you take before you recommend a client buy a property?
Yeah, look, I always like to take a macro and micro approach when assessing a property. So firstly, again, we have to understand the location and the infrastructure that goes on around that area and what developments are going on, how much supply it's coming in as well, and how that is going to impact the supply and demand and the vacancy in the area. Once we understand that, we probably look more into the zoning and the allowed uses. And then we go and do a full due diligence as well on the property itself, comprising of the conditions of it. And yes, definitely we'll touch on the building and pest and the strata report, but also, the comparable rates for rent and for sale in the area that we spoke about briefly before. And then we do a deep dive into the lease, because we have to understand as much as possible about the lease, how strong it is, and what annual increases are associated with that. Is there an option for the tenant to renew? Is there going to be a market review of the rental when they take up the option? Are there going to be any strange clauses that allow the tenant to move out without you knowing? And then what about the tenant itself? Is it just another coffee shop next to each other, another 3 coffee shops in the same street? Or is it going to be a panel beater or an electrician, and they have no competition in that local area? So how sustainable is their business?
That's excellent. That's fantastic. Look, I know that you take great care with clients. Another question I've got for you is I guess, how do you sort of, as a buyer's agent, help the investor through that whole process? And if someone is going to consider using a buyer's agent to buy commercial property, what sort of quality should they look for in that buyer's agent?
How do I help? I guess, I try to condense, if that's the right word, my 10-year experience into a 1 to 3 months experience for the buyer, for our client. Try to make them understand as much as possible, firstly, about who they are, what they want to buy, their risk profile, and what kind of property could be suitable for them. And then give them an overview of the different markets and the different asset types. Some people may be agnostic to location and assets. Others may come with bad experiences and say, no, I don't want to buy industrial, or I don't want to buy office, or I do. So we have to take that into account and scout for the right property for them. Obviously, most of our purchases happen on an off-market basis, so giving them more options to choose from in a safe environment, because now that the market is pretty cool, it's okay to buy, but when the market is really hot, we also have to protect the investor or the buyer from making crazy decisions because they missed out, or they've been looking for the right property for 6 or 12 months. And we always have to highlight what are the pros and what are the cons of each and every option and opportunity that we present. So, and we like to, give options to choose from, at least a few, and not just one saying this is the best one for you to buy, but give at least 3 options for them to confront with each other and then go for the best.
That's it. Well, it is an iterative process, isn't it, with every
client? Yeah, it
because,
is.
Often, in your heart of hearts, it's a good one, but the client may not understand that the one you presented first is the best, and they need comparison. And that's part of our process is we do the comparable sales analysis and comparable opportunity. Look at what else is available, and you compare the pros and cons to help the client make the best decision available.
Yeah, exactly. And obviously it's also about simplifying the communication with them, because even myself, in some cases, I give for granted that they would understand what I mean, but it's my fault. I have to make it simpler, and make them do step by step, because they also have to learn and understand and make an educated decision along the process. But in terms of qualities that a commercial buyer's agent should have, for anyone that wants to talk to one, I guess having experience, having previous experience as a sales and leasing agent would be a big plus. Simply because, the lease is so important when buying an investment. And if that buyer's agent has been an agent before, and they used to put together leases and lease property to tenants, they understand the dynamic. So that will be definitely a big plus for the client that has got the support and help of someone that has been on the other side of the transaction. I would look for someone that has boots on the ground, so that actually walks the streets, that inspects the property that they buy, and not just doing a desktop search and buying on the other side of Australia without ever seeing the property. But I would want someone that knows more than me, and also obviously they can deliver a very solid due diligence, because we know how important that is. We touched on that.
Fantastic. And Alberto, just to add to that, I'd also recommend that any aspiring buyers out there that want to use a buyer's agent should choose someone who's got a great communication ability, that is very clear and concise in their communication. And as you said, they're local. They live and work in the areas that they're servicing. And also importantly, very importantly, have an extensive network. I know, Alberto, you have been in the industry for over a decade, and over that time have built up an incredible amount of connections, and a lot of the properties you find are off-market opportunities. So you'll never see them advertised on Real Commercial or any of the other websites. And having that ability to access those kind of properties that stack up without as much competition makes a huge win for the client as well.
And probably try to avoid those so-called buyer's agents that, they've got a connection with developers, and they're just trying to flog you their overpriced stock that no one else would ever buy. So I would definitely stay away from them.
Yeah, that's a no-brainer. Alberto, wanted to ask you about the future and trends. Are you seeing any particular trends that are worth commenting about in the commercial property at the market?
I'm seeing more and more clients migrating from residential to commercial, especially now with these high interest rates. People want a positively geared asset, or an asset that can help with the repayments of the resi portfolio. So this is obviously inflating the pool of buyers out there, which is good for whoever is in in the commercial space. So this is definitely going to create more and more waves in our market. Right now, it's, similar to Resi. I guess we very much depend on the interest rate talk. So when and if those are going to change, they will greatly impact, again, the number of buyers that are going to be in the market. So more buyers means more competition, lower yields, higher prices. So if someone can jump on buying something or an investment right now, it definitely is the best time to buy. So those are dynamics to take into consideration. And, as we touched on the different asset types before, I believe industrial has still got a lot to give. If you are a more seasoned investor, you can purchase a value add rather than a set and forget, even better. And, keep a close eye on retail and office space as well, because they've been suffering for a long time, but it's not going to stay like that forever.
Interesting. Fantastic. So really, really good thoughts there. Could you maybe just outline some case studies or share an example of some clients that you've helped facilitate? Maybe just tell us, what was the brief they gave you, maybe their budget, and how you delivered on that particular brief that they gave you.
Yeah, one of the most recent client was a Sydney-based client that wanted to buy, had a budget of about $5.5 million. They wanted to buy in Brisbane, a low site coverage, as large as possible property. They're a bit more experienced, so they were able to to take on risk, and they didn't need to buy a property with 5-year lease, but just 1 or 2 years was perfect for them. And they wanted to hit minimum 6% yield, ideally 6.5%, and with a bit of meat in it as well. So after probably 2 or 3 months, we missed out on one. And there were other opportunities that were good on paper, but then doing a bit of due diligence, they didn't work out to be as good. We found a property that is in south of Brisbane. It currently is delivering a 6.5% yield, and the rent is below market by 10-20%. And there is a 2-year lease attached to it. So basically what that means is in 2 years' time, they will be able to readjust the rent to what that look like in 2 years' time. So there will be an uplift of minimum 10-20%, if not more, in yield and in value. We purchased that for $5.35 million. So within their brief, within their budget, and definitely surpassing their yield expectations, and also in terms of value add. That was a fantastic purchase.
Fantastic. I know you've done a lot of work too for investors sort of around the 1.5 to 2 million. You've done quite a lot of industrial properties around southeast Queensland. What sort of yields are you getting on those sort of properties?
We're getting those around 6%, and it is still possible, again, depending on what it is and how good and strong the lease is. There was another client that we purchased for very recently. Their budget was 1.2, and I found this off market for $1,075,000. The brief was 1.2 million, purchased for their self-managed super fund, so needed to have a minimum of 3-year lease, ideally a newer property. So it's the first purchase for this client. So I found this one for $1,075,000, delivering a 6% yield with annual increases of 4%. 5-year lease, which is quite unusual for a smaller property like that, and leads to a very, very good tenant, national tenant. So strong tenancy. It's a strata unit, part of a complex that was completed only a year ago.
Mm-hmm.
So we literally ticked all the boxes
Brilliant.
for this
Fantastic.
client.
Yeah. And I won't say the name, but first name was Jamie. We helped a client who's bought a number of residential properties through us many years ago. And I think he's bought about 6 or 7. We decided that he wanted to start buying commercial. So you helped him to buy his first commercial, but there was quite a bit of resistance or sort of risk aversion, I should say, wasn't there, in helping him buy that property. He had a budget of around 4 million. And you bought something for him up on the Central Coast. And it was, I just remember the conversations. He rang me several times as well, going, Rich, am I making the right decision? Is commercial really going to work? And anyway, look, you did a lot of work in the background to reassure him. He ended up going ahead with the opportunity. But I remember that you found him, well, firstly, it was off market. You priced it at 4 million. It had a 7 plus 7 year brand new lease in place. Not
That's
5
right.
plus 5, a 7 plus 7, which is even more unusual. And after he bought it, I think you said 2 months later, another unit in the same complex sold for about 15 or 20% more. Is that right?
Yeah.
So not only did he get deal of the century, but he also got an immediate uplift in capital value. So if that's not a great success story, I don't know what is, So
that's right. And I'll tell you more about that because right today I was speaking to the agent that sold us that property, and he told me in that complex the rent has gone up by more than 30% in just 3 years. So he's going to be very happy. Very
I'll have to
happy.
give him a call to let him know. I've got just a couple more questions for you, if that's okay.
Sure.
Alberto. But really just to finish off, any sort of final advice that you'd give to our listeners who are thinking about buying in commercial property? Any sort of final thoughts you'd give?
I would say do your research. Start having a browse around on commercial real estate, real commercial. Have a look at what properties get your attention and why. Start to understand, what yields they're selling for, how long the leases are. Surely enough, you'll be attracted to the fancy, brand new, like I said before, petrol stations or food selling at auction. Keep track of those yields as well. They're very, very sharp. Talk to your accountant, talk to your broker, understand your circumstances, your situation, and then decide whether, commercial is something that you can do for yourself. If you've got time to do it, you have enough knowledge. Otherwise, have a chat around to agents and buyers agents, and that's probably the best way to get started.
Fantastic. And maybe just what's the biggest mistakes that you've seen investors make that perhaps do it on their own? What are the classic sort of things that they trip over themselves doing in this process?
The classic is going for the high yield, going for the property that, oh my God, nobody has seen this, and it's delivering a very high yield. And 1 year later, your property is empty, and you'll be reaping 20% below market, rent below what you paid for. So that is the biggest mistake that novice investors do.
Yeah, I think also people should need to realize that yield is just not a reflection of the amount of money it kicks off, but also a reflection of risk. And I think people have short memories with COVID where so many commercial properties were vacant, and yet there were laws in place which meant that you couldn't even remove the tenant. So you're not only stuck with an asset paying a mortgage, but you couldn't get a replacement tenant. So you've got to factor in bigger buffers with commercial, factor in bigger deposits, but also realize that it does have some very attractive upsides in terms of extra yield and an extra longevity with the tenants as well.
That's right. Because it's another reason why commercial investors like the asset type is, we didn't really touch it enough, but leases are much longer than residential. Usually we're talking about 3 years or 5 years or 7, like you said, plus options. So the same tenant could stay in the same property for forever, for 20, 30 years.
Yeah, that's right. They built their business there, foot traffic, we've got all that going.
Exactly.
Yeah.
That's right.
Well, Alberto, I'm going to let you off the hook. It's late in the afternoon. Can I say thank you very much for joining us on the Propertybuyer Podcast. You've been a treasure trove of knowledge today. Thank you.
Pleasure, Rich. Thank you very much for having me. And I'll see you next time.
Thank you, everybody. thanks for being with us on another Property Buyer podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry and we'd be delighted to help. Please visit our website at propertybuyer.com.au where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer podcast.